Hello everyone, welcome to day or part 2 of the volume spread analysis mentorship program, the key principles used in volume spread analysis. And today we're going to be looking at signs of strength. Last Saturday we looked at signs of weakness. Now what I want to start with is exactly how I started the last session, is with the naked chart. And there it is. Okay, so this is what we call the naked chart, and I'm going to start by building this chart up from scratch and showing you some of the tools that we use to identify trends, support and resistance, ultra high volume bars, ultra low volume bars, and key principles in the VSA methodology. So let's start by looking at this chart. Now we're looking at a chart here which has got no volume on it. It's got nothing but price bars, as you can see. You'll notice you've got wide ranging bars and you've got narrow ranging bars. They're all important, as we can see here. Let me show you what I mean by a range of a bar. When I refer to the range in volume spread analysis, or the spread, we're referring to the high and the low of the price bar. And let's remember we're looking at volume, which I've squashed at the moment for the purposes of this starting point of this training course, because what we want to look at is why do we have some wide ranging bars, and then why do we have narrow ranging bars into these areas, causing the market to rally. Now, this is an example of the weekly chart of the E-mini S&P futures contract. We've made all-time highs. Ironically, this has happened, this whole period of rising prices has happened when the news about the economies in the world has been at its worst. And this is why it's absolutely vital to remember that you mustn't be programmed by what you see in the media, on the television and in the newspapers, because professional money don't take much notice. They're often in control of the news stories anyway. So it's very important that you just look at the chart. Now last week we showed you a chart of gold. We showed you a market top. We showed you how gold had its biggest 30-year fall in 2013, all predicted in the price charts. But keep in mind, in 2011, if you'd have switched on your television in late August, early September, you would have been told by all the experts, and I mean nearly all of the experts in the financial markets, that gold was indeed the safe haven. It was there to protect you. It was a great investment. But we know that has to be rubbish when we're using VSA, because volume spread analysis is the truth. I had an email from a customer who shall remain nameless, who bought our product about 9 weeks ago. And he's come into our live trading room, and he's been diligently studying. He's in this mentorship course. And he said something in an email which, as I say, hopefully I'll be able to get permission to use it. But he said, I've been studying the markets, Gavin, for 20 years. And I was on the verge of giving up. I was that close. He said, I just couldn't understand it. I'd bought gold right at that top. I'd sold my stocks holdings when I was told the stock market was falling back here in August of 2011. He said, everything seemed to make sense. He said, in gold, if you looked at a stochastic or a moving average, everything said buy. I switched the television on. There's Goldman Sachs recommending gold's going to go higher. There's some of the top experts in their field saying gold's going to go higher, and I'm getting buy signals, Gavin. And I lost a lot of money in gold because I hung on and hung on and hung on until it went down to 1,300. I couldn't hold on any longer. I'd lost too much money. I was about to give up. Then I found volume spread analysis, and I read your book and I read Tom's book. And in the last 9 weeks, he tells me he's completely changed his view of the market. He's not only making winning trades, he's making cleverer trades and better trading decisions. That's what you must understand with volume spread analysis. You're analysing the activity of the professional money. So let's look at this chart. So this is the weekly chart using the Trade Guider V4 program, which I use. We have two software versions of our main core software, Trade Guider Real Time and Trade Guider End of Day. And then around those are built what we call the add-in studies, for those of you that have asked, which are basically taking 6 or 7 of the core components of the Trade Guider program and building them into other software programs. And at the moment, we support NinjaTrader, Infinity Charts, Sierra Charts, TradeStation, eSignal, Metastock, and MT4 at the moment, and we'll be working on others in the future. So let's start by making this chart make sense to us. So the first thing I want to do is bring the volume up at the bottom. This is the volume at the bottom of the screen. It's the most important part of what we do and what we analyse. Now, does anybody notice any unusually high volume? That's what we look for first. And if you do see it, where do you see it? Let me ask the live audience here. Where do you see the high, very high volume? And again, look at it. Is it on a down bar? And a down bar, remember, is a price bar that has closed lower than the close of the previous bar. Where do you notice the very unusual volume? And let me ask you again, do you notice it on a down bar or an up bar? Okay, David's already spotted it. This is a weekly chart, remember, so every one of these bars is a weekly bar. Okay, David quite rightly says, and I hope you all spotted it, I hope you're not half asleep there, it's here and it's on a down bar. What is a down bar? It's a price bar that closed lower than the bar behind it. Okay, you can see it quite clearly on these two bars. Also, we always pay special attention to price bars that have a very wide range on that type of volume. They're very important because not only is something going on over those 2 weeks, but the activity level is the highest. It's 28.03 million contracts. That's more than we've seen for several years. So we know something's happening on this down bar. Now, one of the things that we taught you last week is when weakness appears, i.e. shorting opportunities, they happen as the market goes up on very high volume, as we see up here. And when buying opportunities or strength comes in, they happen on down bars as the price falls, as we can see here. And you can clearly see something very interesting about this price bar here, this wide-ranging bar. What do you all notice about the close of the bar? Just type it in for me. What do you notice about the closing price on this bar with the very massive volume? Just wait for you to type in. What do you notice about the closing price? This is very important about what I'm about to show you. Yeah, well done, Donald. Well done, David. Well done, Vasily. That's exactly right. It's closed on the high of the bar. Now that's significant. Remember, the close is still lower than the bar behind it here, but it's closed on the high. Now that means something. Now I'm going to teach you something now, which is Wyckofian, based on the work of Richard D. Wyckoff. For those of you that are studying VSA, there's a very good website you might want to go and look at. It's going to be launched in a few weeks' time. It's www.richardwyckoff, spell RICHARD, WYCKOFF.org, richardwyckoff.org. This setup that you see here and here is called a spring. And I'm going to show you this now and show you what's going on this bar here. There is a great deal of supply present, and that means that there are sellers in there and buyers all interacting. Now, this was the 12th of August of 2011, and it was the week that the US government was downgraded by S&P, and we were told the stock market was going to collapse. And indeed, the previous week, we'd had one of the biggest falls we'd seen. And then it fell again and made another low. Look at the wide-ranging bars here. Look at the volume. Wyckoff would refer to these as hypodermics because it's really prodding the market down. But what caught my interest was what had happened in gold on that week and then what happened in the S&P. If you're studying VSA, I highly recommend you go and look at the gold chart, which I showed last week in the first part of this training course on the 12th of August, and you'll see that gold had rallied and this one had fallen. The news on gold was buy me up here. The news about the S&P was get the hell out, stocks are going to fall. But when you hear that type of information, it's time to do the opposite of what the herd do. Warren Buffett one of the greatest investors of all time, said you can't buy something that's popular and do well. The time to buy is when others are selling or telling you to get out. And in the stock market, if you have a VSA principle called a shakeout, preceded by climactic action, that's the time to start looking. Now, if you don't believe this, one of the best charts you'll ever see, maybe I'll show it in a minute, is the chart of British Petroleum, BP, in June and July of 2010. If you really want convincing that volume spread analysis is the way to trade, just go and look at the chart of British Petroleum. I'll show it actually before we move to the slides. Here's what happened. 2010, we know in April there was a major oil spill in the Gulf of Mexico. The shares in BP began to plummet very, very quickly. A little bit, they looked a little bit like this. And week in, week out, as we began to see images on the television of this oil gushing into the Gulf of Mexico, and we began to see images of BP's executives nodding their heads thinking we might have to sell BP to the Libyan government, was one story I heard. And I looked at the chart, and then in June of 2010, there was a massive, massive volume bar, highest I'd ever seen in BP. And I follow that stock. I'm a specialist in that stock. And suddenly, I looked at it, and I was going to speak the following week at the Massachusetts Institute of Technology, MIT, where I was speaking on how to pick stocks. And Tom Williams rang me up, and he said, Gavin, he said, look, have you seen this shakeout signal in BP? I said, well, yeah. I said, it can't be right, Tom. I said, they can't cap the well. We've just heard it on television. It's all over the newspapers. BP stands to lose billions and billions of dollars. That should wipe the share price out. And Tom said, well, look, on the weekly chart of BP, there's a clear principle, Gavin, and you ignore it at your peril. He said, trust VSA, don't trust anything else. I did trust it. The following week, we had an up bar. Couldn't believe it. Each day, the market from BP was starting to rally. So I went to this seminar in Boston, and I shared this knowledge with the audience, and they all started laughing when I said that I thought BP was offering us a great opportunity to buy the stock at $26 if you're trading on the US exchange. It was also traded in London. And it was what happened here in this chart was almost identical to what happened to BP. And then for a few weeks, BP went sideways, and then BP, as you go and look at the chart, nearly doubled in value in 6 months from June when the signal appeared. So I asked myself, we did a seminar about 9 months later in Heathrow. We were in the seminar, and Tom discussed this particular stock, BP, and Tom then said, he said, in my opinion, it's only his opinion, we think they capped the well on that first week of June, but kept a video loop running and then told the public that they couldn't cap the well while they accumulated the stock. And a member of the audience happened to be a BP engineer, and he nodded and confirmed it. He said, I can never tell you that publicly. He said, that's exactly what happened. So remember, when you see a principle on a chart, but the news might conflict with that principle, trust the chart, because the chart doesn't lie, as we're about to show you. So let's build this chart now. Now, the first thing we're going to do, we're going to switch on our trending system, the medium-term trending system. Now, we do that by clicking this button up here. Now, if I click the button off, the default setting is that blue bars are up and red bars are down bars. So any blue bar, and you can change these colors, by the way. If you like green and red, absolutely fine. I like blue just because of the color I got used to when I started trading with Trade Guider. So you can see here we've got 4 up bars that are blue after this particular bar here. That tells you something. This is what we call the spring bar. The volume is the 3rd highest since this volume. It just takes out the low of this very high volume bar, but it closes on the high again. This is what you call a spring. If you ever see very high volume and then the next bar comes down, dips below the low of the bar and closes on the high, that is a very strong indication of higher prices in the future. And by the way, what I'm showing you here will work on a 1-minute chart, as well as a 10-minute chart, as well as a 1-hour chart, a 4-hour chart, a daily or a weekly chart. because the principles don't change. When you're looking at VSA, the principles work in all time frames simply because the software and the methodology, volume spread analysis, is designed to measure imbalances in the supply and demand situation in the time frames that you're looking at. And you can choose your time frames. Some of our customers use just monthly, weekly and daily charts. That's all they use to make their investment decisions. They're not scalping the market. They're not in and out within a few hours. They're holding positions long term. So they don't care what happens on a 2-minute chart. We've got other customers who trade a 1 minute, 2 minute, 3 minute chart. Okay, nothing wrong with that at all. Remember, volume spread analysis will work in multiple time frames and will work in any time frame you choose once you learn how to interpret it. I actually use in my trading plan 4 separate time frames in most. That's usually I'm looking at 4. No more, no less, 4 time frames. That gives me my highest probability setups. So now what's missing off this chart is 2 other very important ingredients: the VSA indicators and the short-term trending system. So this is the medium-term trending system now, and you can see the blue bars here indicate a medium-term trend. Now, simply put, when you have a range of bars that has very few red bars in it, as you can see here, you're in a very strong medium-term trend, and we are at the moment in the S&P. If I then put the diamond trending system on, you'll see that this has hardly changed. You've got 1 red diamond in the whole of this uptrend in the S&P, and we began to change on this bar here. That's when we started to change green. And what my golden rule personally for trading these markets is, if I see an ultra high volume down bar, this happens to be what we call a shakeout, as I'll show you, and then I get 3 green diamonds on the big time frame and 3 blue bars on the big time frame, which happens to be the weekly, I'm looking for long trades from that moment on, because we've changed behavior. Now, one of the other important things about strength is we have VSA signals, and you can see we actually had a cluster of 5 at the bottom of the E-mini S&P, and in fact it marked the bottom of the FTSE, the NASDAQ, the Dow Jones. Most of the charts had this on them, and I call these sequences. And the sequences appear and are programmed into our scanners to look at 1 bar, 2 bar or 3 bars. And I'm going to show you here a 3-bar sequence that marks a bottom. Now, when we look at a VSA indicator, we don't just look at green and say buy. And we don't just look at red and just say sell. That would be lovely and simple. I could easily market the product that way, because many times the signals are so good, you could say that. But there's a little bit more interpretation required. And I said it last week, I'll say it again. Learning volume spread analysis is a bit like learning a language. And as long as you're prepared to put in the time and effort, and it doesn't take too much, then you can learn this language. And how you learn the language is practice, repetition. Please read the books that we've provided. I mean, they took a lot of years to write. It's a lot of information. The books that we recommend you start with is Master the Markets by Tom Williams, and the book that I've written called Trading in the Shadow of the Smart Money. Now, those books are very easily accessible. My book sold over 500,000 copies already. People have come back to me and told me it's changed the way they view the market. So, and that information that I wrote about in my book is information I gathered over a period of years through talking to Tom Williams, studying the Wyckoff method, meeting some great traders and learning from them. So please, if you've got an opportunity, have a look at it and read it, and that will give you a great starting point. But then how I learned to trade was when I got the software, Tom said to me, you must read the dialogue boxes that I've produced. And these were rewritten a few years ago now. They've been around for 22 years, but they were rewritten by a man called Philip Friston, who worked directly with Tom Williams to clarify what's going on. Now, a shakeout has a number. Every VSA principle that we have developed has a number. There's over 349 principles in the software. However, all the principles are based on 16 core VSA setups, which I'm just about to show you the 8 that are signs of strength, and 4 what I call key trade setups, which make up the 20. So you've got 16 key principles and 4 high probability, and I would call them buy signals and sell signals. I wouldn't even hesitate to say they're not. I'm very cautious about using the word buy and sell signal in our software because I've seen people get burned by software that claims that their software is an instantaneous buy and sell signal system. There are 4 setups, and I'm going to show you them at the end here, which I would consider to be buy and sell signals. And I use them as such, and they're programmed into the scanner as such. So a shakeout is the start of a 3-bar sequence. Okay, that's the start. But there's a problem when you see a shakeout. The volume, if it's like this, is ultra high. Now, if we look at the right-hand side down here, in all the plugins that we have, the add-in studies, and here again in the software, it tells you what the bar is. It's a down bar, which means the software knows that we've closed lower than the previous bar. The volume is UH high, ultra high. That's as high as it gets in TradeGuider. And that means it's much, much higher than the bars around it. But you can see that with your own eyes. The spread is ultra wide. Now, if you see an ultra high volume bar, be it up or down, with an ultra high spread or ultra wide spread, that is the first part of your setup. It doesn't mean do anything yet. It needs confirmation. It's the first part of the setup. Now, I called it, when I wrote the sequences, because I developed that, that's my intellectual property, I realized that a lot of the VSA setups start with ultra high volume, and then they finish with very low volume into that same area. I also noticed that the setups appeared within 25 price bars. And if as long as those signals were within 25 bars from the moment the first one appears, you've got a trade. Now here, when I see the first ultra high volume bar, I start the 25 bar count and look for principles. So there's the second bar, third bar. Now the fourth bar gives me a red signal. It's not wrong. It's that the market's not ready to go up yet. So deliberately it's marked up and pushed back down, as we can see. Now the next thing that happens after ultra high volume is you see what's called testing of the market. And we have in the software tests that have green SOS and red SOWs, because you can also have what we call a failed test. Now in this case, the test actually held, which meant for me that actually here on sign of strength 6, which is the second part of the sequence, professional money here are still bullish. But have the diamonds changed to green? Have the bars changed to blue? No. There's no trade, but there's the start of a setup. And I didn't go long here. And in fact, it was in here I did the seminar in Florida. We did a best of Wyckoff course, and I was asked by a big fund manager, do I think the market's bullish? I said, well, what I need to see now is some type of spring action in the market, followed by no supply. And if I saw that, I would become very bullish. Well, over here, we have another test, but this is a test after the shakeout. So when you see those 3 things happening, especially if you see, and write this down, if you see sign of strength 34, followed a few bars later in any time frame by number 16 closing on the high of the bar with the tail of the bar lower than the shakeout bar but closing on the high, that's almost as close as I'm going to give you to a buy signal. However, I still like confirmation. And after we look at that one there, and by the way, this is programmed into the scanner. So when you, for those of you that have brought the TradeGuider scanners for Infinity or Ninja Trader, and we are building them for MT4 as well, this particular setup will automatically send you an email. You've got sign of strength 34, sign of strength 16, and you're still counting the bars. I'm ignoring this signal, by the way. This is not part of the sequence. It happened to appear, but it's not part of the sequence, okay? What I'm looking for is that one there, number 16, okay? So you will get sometimes in a 25-bar sequence other indicators that appear, but the sequencer will ignore them. It won't look for them. It's only looking for the numbers within 25 bars. So here's your first one, 2, 3, 4, 5, 6, 7, 8, 9. So on the 9th bar after the shakeout appears number 16, 10, 11, 12, 13, 14, 15, and then 16 appears. Now this is the completion within 25 bars of the sequence. Number 81, no supply. The most important part, however, that the sequencer does not yet look for is the next bar, but it will do. Because to complete the buy setup on this, I'm going to be programming into the sequencer next week the confirmation bar. Because the most important thing is we must have, okay, confirmation. We want the next bar to close higher. And if we read the background here, it says no supply works best when there is strength in the background. What does that mean? It means that. That is a strong, well, look, you can't argue that's not a strong bar. Look at the market. It's made historic highs. Absolutely historic highs. Okay, so you can see here that there is massive, massive, massive volume coming in there. And that means we know that there is definitely here buying. Buying always happens, okay, when the public panic and the herd panic. Okay, and when the herd panic, we know that there will be a shakeout. And in fact, that's exactly what happened here. There was a shakeout, a violent shakeout, which actually, ironically, caused the market to actually go up. Now, when we see that setup, the safest thing we can do is wait for the change in behavior. Okay? And once you do that, when you see that change in behavior, then we can go long. So this is exactly how you trade this. You mark the top, not the close, the top of the ultra high volume bar. Okay? Mark the top. Put a big, big green line across it, or whatever software you're using, put a line on it. And this works, I will repeat, this works in any time frame. Okay, so I've traded this setup on a 3-minute chart and made some very good money on a 3-minute chart. So please don't look at this in isolation. Well, oh, Gavin's just looking at a weekly chart. This won't work in a 1-minute chart. It absolutely does. And in our live trading room, we absolutely prove that. So what we see here, clearly what we see is the change in behavior happens, and this is how we identify it in Trade Guider, when we get the third green diamond followed by the third blue bar. So on that bar there, this market has been deemed to have changed behavior. Okay, and I'm going to show you why right now. So here we can see we've got the first, second, third, fourth, fifth, sixth green. So you've got 6 green diamonds and 3 blue bars. And we've taken out the top of this bar here, okay? And then, as we can see, the safest place to place a trade is on these 2 indicators just there. Now, you will get a trade alert, assuming you've got the software, when these 3 bars are filled. Once the alert is given, you wait for the next bar to close higher, and then here, you look for these tests. Now notice the pullbacks are on low volume. If you want to place a stop, you place the stop right underneath the top there of the bar. So where the closing price on the shakeout is where you put a stop. Now for some people, that's far too far away. Okay. Now, when you see that particular setup, you will find when you see that setup that on another time frame, like a daily chart, you'll find these diamonds here, or even say a 4-hour chart, will change sooner than a weekly chart. So it is perfectly feasible and possible for you to have got in on the daily chart when you saw that signal there, because here there's no green indicator on the 30th of December on the weekly chart, but on the daily chart there was. Okay. Is there any questions about how we determine the trends, how we look at this setup? Because now I'm going to go into the signs of strength in more detail. Is there any questions so far on that? Any questions at all? Let's just have a quick look. Just go to my screen here. Okay, any questions at all on that? It's not difficult, it's not complicated, but it's a good way to start this session and show you the importance of how we utilize that. Okay, I'm just waiting for the questions to come in. Okay, I'm just answering a couple of people back here. Okay, could I explain why, is the question. Could I explain where you put your stop again? Stops are very, very individual, David. I don't like to tell anyone where to put a stop. But in a situation like this, assuming I'm trading a 3-minute chart, as soon as I see a test, okay, I will put the stop. See where the shakeout bar is a couple of ticks below the top of the shakeout bar. Okay, sometimes if you've gone long on a shakeout, that can happen. But the reason I wouldn't be long there is we haven't changed behaviour. We're still red. So I wouldn't take that trade. But this is a trade I actually took. So I actually took this trade. And this didn't stop me out. This downward movement here, this 2-bar reversal here didn't stop me out. And then over here, you can see as we've moved up, we had a very nice test in October of 2013. And remember, that's a test in a rising market. Behind us here, we got another test. And this test was the strongest one of 2013. And you can see what it's done to the chart. The question is, you can see here, another question is, would this work in Forex? Yes, absolutely. Absolutely it does. Yeah, everything I'm showing you here would work in a Forex chart. It would work in a stock chart. I just happen to have picked a futures contract. It doesn't matter. Please don't pigeonhole yourself and think just because I'm looking at the E-mini S&P that this wouldn't work in an Australian stock like BHP Billiton or a Chinese stock or an Indian stock or a Polish stock. It works in everything. So please, let's get that straight out the way. Everything I'm teaching you will work in any market where you get volume and you've got liquidity. Vasily says, do I use the volume thermometer? Now, there's a great question which I haven't even shown you yet. Now, this is represented here, as you can see, on the right-hand side of your screen. And that's what Vasily's referring to. And I do use this, yes. Not so much for trading, more to measure if we're in a bull or a bear move. Now, if I start from the bottom here of the chart, where my cursor is to the left, if you look to the right-hand side, watch what happens as the market dips and builds its cause to go up. As soon as the volume thermometer, which it currently is at a 50% level down here, as soon as it starts to go and become bullish in the market, this thermometer will become bullish. But remember, this is averaged over several bars. So this thermometer works very good on a daily chart. If you're using a daily chart and you want to just look and say to yourself, is this a bullish market or a bear market? Let's have a quick look what happens now. I'm going to move forward with the cursor, and I want you to just study here what happens each time I move forward. So I've moved forward once, twice, we have a bit of no demand. Okay, market still is in a bullish territory. It goes up again, it's still bullish. We have a test, but it's still bullish. Now, it doesn't like the test, it fails, so it retests, and we're at equilibrium. The next bar closes lower. But on that low volume test, the next bar actually responds positively. We go up again, we go up again, we encounter some supply. Because of the supply, the market retests. But now we get one of the strongest tests of the year. Now look at the thermometer. We've got a green test, and now the software is seeing that it's building a cause for another move up. And we have a positive response, another positive response, another positive response. Now look at the volume here, right? This is how I know that the market's been bullish. Look at that now. In November of 2013, we were a very, very bullish area of the market. It was actually completely green, as you can see at that point on the weekly chart, and the daily chart was green for the whole week, and all you would be looking for at that point would be long trades on the intraday market. And next week we close higher again. The following week, the market runs out of energy. But look, the thermometer didn't change for 3 weeks. So guess what? Because we were closing up on the highs and I saw healthy closes here, I was looking for intraday long trading positions. Okay, and boom, I got them. Then the next bar, still bullish. Now we have a correction, not a big one, a down bar. The volume is average, as we can see, software tells us, but look at the response to it. Massive response. That makes another high, okay? S&P hits 1818. The next bar goes up on no demand because obviously there's only so much energy the market can push higher. We have a down bar now, so we start to turn a little bit bearish back in the early part of January, but then we're still bullish at the moment. We're still at about 75%, and if we look at this bar here, there's a little bit of negativity come in only because the spread of the bar is narrow on an increase in volume. But I wouldn't analyse that bar until Monday because it hasn't closed, to answer your question. Okay, so that's how we use the volume thermometer in the program, Vasily. Is there any questions before I go to the PowerPoints? Any questions at all? But do I use the volume to make trading decisions as such? No. I'm using the VSA sequences and the alerts to make my decisions trading. Any questions at all before we move on? Okay. All right. Doesn't look like there's any questions. So what we'll do, let's go over and switch screens. All right. So the VSA signs of strength and how we trade them. So last week we talked about weakness. We showed the trending systems and when the market's weak. We had some great trades last week, short, by the way. If you're in our live trading room, you saw on Thursday and Friday, great trades. We made very good trades last week, and most of them were short. Most of them were short. But when a market is strong, I'm going to show you some of the best principles that you can identify. So what determines a sign of strength? Well, the majority of signs of strength are on down bars, meaning the market's going lower. And that makes total sense. If you think about it, in the financial markets, you want to buy low and sell high. So it makes complete sense that strength would appear on a down bar because it's appearing in a lower price. And if you wanted to buy something and you knew it was at $5,000, but next week it was going to be $2,000, you wouldn't be buying it at $5,000. You'd wait a week and buy it at $2,000. Now, it's exactly the same. If you turned all the signs of weakness upside down, you'd have your signs of strength. So, for instance, end of a rising market, which we talked about last week, if you turn that upside down, you end up with bag holding. So that means that the volume on a sign of strength can be very high or very low. But again, in a sequence, it starts with very high volume and is followed by very low volume at the same price level. And the significance of that is the high volume is the activity of the smart money doing something. The low volume tells you they're no longer active at that same price level, and that means something. A narrow spread on very high volume is a very powerful signal, but a narrow spread on very low volume is also a very powerful signal because it tells you that there's no professional seller, especially if it's on a down bar. Any attempt for a market to move down will not go any lower if you see an ultra-high volume bar with a narrow spread. A narrow range on a bar has great significance. To me, more significance than a wide range. Ultra-high volume bars, especially down bars, are traps. Now, what do I mean by a trap? Well, I just showed you that in the E-mini S&P weekly chart. The news is bad very often. This happens with stocks as well. The price is deliberately marked down. Sellers start to panic and they get rid of their interests, and this gives the opportunity to the smart money to come in and buy. So when you get very high volume in a market, it means that the professionals are buying, and usually we call it the herd or the general public are selling. When you see ultra high volume, that means there's panic selling going on, like you saw in, well, I'll show you the BP chart in a minute. Low volume shows no interest to the downside from the smart money. Now let me just show you on British Petroleum quickly what I mean. Okay, British Petroleum. Weekly chart. We cannot cap the well. Selling climax. Okay, just here. Look at the volume on it. Big green signal. 11th of June 2010. We can't cap the well. Market falls a bit further. Right at the bottom here, stopping volume. Then we change behaviour, but we change behaviour there. That's the safest buy you could have had. And you would have made money even there at $40 until you encountered supply up here, which you did. It was a very high volume bar. That would have told you that that's not going to go much higher. You could have made your $10 trade. That would have been a very good setup because you penetrated this area. Now, the interesting thing was this came back down into that area and we sprung. This is what we call a spring. Again, if you look at this, number 13 this time, the test. But this is a strong signal. And I expect BP to make new highs over the coming 8 to 9 weeks. And the reason is, quite clearly here, we've got a very low volume test last week. So BP looks like it will go higher, not lower. And there's strength in the background. So this is one of my favourite signals. And one of the things I'm going to teach you at the end is sign of strength 57, followed by sign of strength 198. Right? So we're going to talk about reversals. Now, when you have a downtrend behind you, as you'll see, and suddenly the market sees a bottom reversal, this is very often enough to change the trend. So a bottom reversal is a widespread down bar closing on the low. So the first bar, it has a wide range to it or spread and closes down near the bottom. The low and the close is lower than the previous 4 bars. Then the next bar is an up bar, which means the price has closed higher than the previous bar. But again, it's going to be on a wide spread, usually a very wide spread, but it's going to close up near the high. Now, this can arrive in a variety of versions, but basically, the first down bar is a shakeout bar, and there'll usually be some bad news accompanying it, especially if it's in a stock or if it's in a commodity. They'll have some sort of negative news to shake the market out. The second bar is rapidly marked back up to lock traders in. So if you went short on the down bar, you're now stuffed, or out of the market, because if you wanted to buy it, you now think, oh, well, it's gone up again. It's a bit too expensive. So you want to wait. And these 2 bar reversals are often tested immediately. Here is one of my favourites, because I traded this. This is JP Morgan, and the news was bad. They had a widespread down bar, as you can see. The volume was very high. But look at this next bar, and it closed higher than that previous bar, and it completely reversed the trend. So the first bar is a shakeout, really. That's what it does. It gets rid of anyone that was, the price at $15 here was a low in this stock. And professional money knew full well that there was a bargain to be had. The news came out, it was negative, and then the next bar, the most important part of that next bar, is that it closes higher than the top of the previous bar. So here, it closes higher than the top of the previous bar. Now that is significant in its own right. Okay, the fact that it's closed higher must tell you that demand here has overcome supply. If that volume was all selling volume, the next bar would close lower. But in this case, it doesn't. It actually closes higher. So we can say, without any shadow of a doubt, that's a reversal. Now, what I will teach you in session 2 is that if you see that and you get an immediate test in this area, just go long, and you put your stop 2 or 3 ticks below the first bar. And very, very rarely will you get stopped out on that. It's a very strong signal. And the signal number that I use in the software that's built into the scanner as well is SOS 57, if you want to write that down. SOS 57. Okay. Again, you can see down here, another US stock. Now, in this instance, occasionally if the volume is very high on the second bar of the reversal, at bar B, as you can see here, bar A is the shakeout type bar, bar B is the reversal bar. Again, it closes level with the top of the next bar. It has an immediate response, but sometimes the professional money, if there's a lot of volume on that bar B, if it's very high, will come back down and test it. But don't be put off, because if you see that and it comes into this area and the volume is now low, like it is at bar D, that's called no supply into the area where there was a bit of supply. The market will double bottom. This is what you'll see, a double bottom in the market. But the most important thing is the volume must be very low at bar D to confirm that indeed we're seeing that weakness. Sorry, that strength. We're confirming the strength that's here on these two bars. All right, let me ask a question. Is there anyone got any questions on a bottom reversal? Yes or no? Anyone have any questions so far about a bottom reversal? Will the scanner email you if it sees a bottom reversal? Yes, it will, John. It will send you an email because it will see sign of strength 57. It's a single bar setup. It's a very, very powerful setup. So the answer is yes. The scanner would alert you. Okay, let me just see if there's any other questions here. Okay, it's a good question. Donald says, on SOS 57, the bottom reversal, should it always close higher than the previous down bar? It has to. It has to close higher. It wouldn't produce a signal otherwise. If it closed lower, it wouldn't be a reversal. It has to close higher. And actually, the software will see it. If it closes above, I'm going to give a little bit away here, but this is a private mentorship course, so I can do it. If the first bar is a down bar, I'll try and draw it for you. Okay, so let's say you've got your high volume here. The first bar is a down bar here. Closes. Let's say it closes on the low. Now the software, if the next bar closed lower, there would be no signal there. In fact, it probably would produce a sign of weakness. But what it looks for is the next bar, if it closes above the 50% line of the previous bar on high volume, it must be high, it mustn't be low. If the volume's low, it won't produce the signal. It will put a reversal signal here in green, looking at these two bars. And very often, as I'm going to talk to you about in part 2, you'll then have one down bar following that on very, very low volume. And the minute that the market penetrates the top of that low volume bar, I'm long, instantly, without hesitation. And very rarely does that not work. So hopefully, Donald, that answers your question. It's a good question. So when you see a bottom reversal, when this sign of strength appears, there will be a downtrend in place behind you, almost definitely. In fact, you should have at least 2 or 3 down bars immediately preceding the bottom reversal. Not always, but mostly. This can often mark the bottom or the turning point of the market. Now, you wait to make at least 3 higher lows on the bar. Now, what does that mean? You don't have to. This is just a rule that you can follow if you want to be conservative. A higher low means, let's say we've seen here the reversal and we've closed up. Let's say we've seen the test. And the test then does this. We have another bar, does that. And then we did another bar, and then it does that. You have now made 3 higher lows, meaning you're trending up. And what will happen here is the diamonds here will start to change green in the software. And the bars will start to change blue here. So if you want to be really conservative, and I mean really conservative, and miss some of this move, you can wait for the diamonds to change to green, the bars to change to blue, or whatever colour you've got them set to, and wait for the first down bar on low volume, which we call no supply. All right, or a test. And that is your entry. It's a very specific, clear, and easy to find entry. You see these all the time. And if you just go next week and practice this setup, I mean, just looking for reversals. Don't look for anything else if you don't want to. Just look at reversals. Last week I showed you a top reversal, followed by no demand. This week now in session 2, we're looking at a bottom reversal, followed by no supply. Now my favourite signal that I traded at the New York Traders Expo was this setup. It was a reversal. I had a shakeout in the background on a 1 hour chart, but on a 3-minute chart, this was the setup I traded in front of over 1,000 people. And I was so confident when I took the trade, I actually said I would be staggered if I lost any money on this trade because it's such a high probability setup. And lo and behold, within 15 minutes, the market had gone up about 6 points on the NASDAQ from the entry. It's a very strong setup. Okay, now last week I talked about Tom Williams' simple trending system for going short. Well, this now applies when you want to go long. And again, if you look at the trade guide trending system, it's based very much on this. The colour of the bars and the colour of the diamonds are looking very much at what this is. So first of all, you find a serious sign of strength. And what I mean by serious is a bottom reversal, bag holding, selling climax shakeouts. Then that area needs to have a low volume bar, which is testing it, or we call that no supply. Then I'll wait to see the result of the strength. I wait about 10 price bars in the time frame I'm looking at, but that's not a golden rule. You could wait less, you could wait more. This is a guideline only. In a strong uptrend, we should see decreasing volume, not excessive or ultra high, on the down bars, and increasing volume, but again, not excessive or ultra high on the up bars. So in a nice healthy trend, you find that the down bars have less volume and the up bars have higher volume, but not ultra high. The minute you see ultra high volume on an up bar, you've got to be careful because it means there could be some profit taking or selling there. Now, in a strong uptrend, you allow for 1 down bar if they're on low to, now I actually allow for 2, by the way, personally, but this is Tom's system, but I actually allow for 2 down bars. If they're on low to average volume, you completely ignore the level bars, which are coloured black by the software, or anything that's close to level. That is a bar that has closed at or near the same price as the previous bar. The end of the uptrend is often seen by 2 consecutive down bars followed by no demand. Okay, that's what you often see. So you have a down bar, followed by no demand. All right, principle 2, stopping volume. You see this every single time you trade. And what I tend to do with this is not necessarily trade it, but be aware of it. See, when you see stopping volume in a market, I mean, I traded the euro on Friday short, and I suddenly saw a shakeout and on a bigger time frame stopping volume. But the trend of price was so strongly down that this stopping volume only managed to move the euro back up 10 ticks before it resumed its downward move. So I don't suggest if you see stopping volume, you suddenly say, that's it, I'm going to buy. Be aware that it's probably the market maker holding the market up, but you must be aware of it. So to stop a down move, you have to have some demand coming in. As a market falls minute after minute or day after day or month after month, a point will be reached when the herd cannot stand the losses, so they all tend to panic at the same time. If the price levels reached are now attractive to professional money, they will step in and buy. This activity causes a surge in volume as they buy, cover their short positions. Now, the best place you'll ever see stopping volume is like this. It's in an uptrend, on a pullback. So if you're in an uptrend in the market and you see ultra high volume on a narrow range with the next bar closing higher, which may even put a reversal signal on there after the stopping volume, then you really need to be considering a long trade. Okay, because number of things are happening there. Stopping volume in an uptrend is very bullish, but stopping volume in a big downtrend may only temporarily move the market up before it reverses again, and you may get caught out. So I tend to trade the stopping volume signals when they're in an uptrend and a pullback, but you will see them in a strong downtrend. I urge you, if you see stopping volume and the diamonds are red and the bars are red in the time frame you're looking at, wait. Don't go long on stopping volume. You only go long when you get the change in behaviour in the market. Here is the stopping volume at the bottom of a market. At bar A, you can see we've got a very high volume bar. It's closed off the low of the bar, but the most important thing at bar B, the next bar is closed higher, and then at C and D, you've got very low volume down bars. We call those tests, and they're deemed to be successful. Tadeusz, you're absolutely right. Tadeusz says that stopping volume actually usually results in just a weak correction in a downtrend, and I couldn't put that better myself. That's exactly correct. In a downtrending market, stopping volume will often produce a very weak correction, and if you see after stopping volume no demand in a downtrend, you can go short, even though you've got that stopping volume there, because very often that stopping volume is only temporary. It's the market maker holding the market up, but that's absolutely correct. Absolutely correct. So stopping volume works much better if you're in an uptrend and you get a pullback and the volume is high and the next bar closes higher after you see the stopping volume, then that is a good place to go long. Now, very often, if a market is turning, meaning that they're trying to hold the price and accumulate, you'll see this happening. This is one of Tom's favourite setups. The market comes down. Now, at bar A, we would love to see a signal called bag holding, which I'm going to talk about in a minute. But in this instance, the volume probably wasn't high enough and we got a stopping volume signal. The next bar responded and the market then went up. But then it came here, found weakness because there's high volume on these up bars. And you can see here we have a level bar. The volume is the same as the previous 3 days, but it closes level. So the next bar is down. We go back up into that area, no demand, and the market falls. But as it falls, the volume is much lower at the same price level. Now, if the next bar responds positively, you know that this is an accumulation area. The professional money have accumulated and they're just testing that price. If the market does this 2 or 3 times and then eventually breaks out above the top of where this bar was, where we initially had the reaction, that's where you buy it, because you'll have had the accumulation, as Wyckoff called it, underneath you, and the minute price action goes above there, you'll often see it happens on a high volume punch through bar. Looks a bit like this. So the market comes up high volume and it punches through. Okay, it's high volume, probably closed near the top, and then you should look for a test, and on the first test, that's where you buy. Very strong signal if you see that, and that would be called absorption volume if we ever see that. Any questions on stopping volume? Just wait and see if there's any questions. Okay, any questions on stopping volume? Okay, I don't think we've got any at the moment. So you're saying, Gavin, that you buy a test and the diamonds and the bars have to be confirming the change in behaviour to green and blue. That's correct. It's exactly correct. Absolutely right. Yeah, a little bit like this. I mean, if you go to the BP chart here, you can see here, there's your climactic action. You come down here, no supply. Here, you change behaviour. I don't think we've got any stopping volume in this. These are just all tests. May have stopping volume. Let's have a see if I can find one. Don't really think there's any stopping volume here that I can show you. Testing. No, not on this chart. There's no real stopping volume on this example anyway. Okay, good. So, if you want to go long after you see stopping volume, remember when smart money or professionals accumulate, you will see it beginning on high volume down bars, but the accumulation phase takes time. Don't try to pick the bottom. After seeing stopping volume, wait for the market to drift up and come back down into the area of stopping volume on low volume. The lower the better. If the spread is narrow and the market makes 2 higher lows within 25 bars, this confirms the long position, and enter on any low volume down bar after this. Place a buy order above the low volume down bar and let the market come to you. This is called a successful test. Okay, number 3, the test. Now, this does seem to confuse some people, the word test, because it's a green signal, but there is a red signal in Trade Guide called a failed test, and that's the most important part of this principle, is that a test can succeed, but it can also fail. So remember, if you see a green signal and the next bar is down and the green signal says test, the test has deemed fail, which means you can ignore it. Or if you've got some weakness in the background, you can go short even though the signal's green because you've got a failed test. Now, tests work best when you've got strength in the background. Okay, so it says here the test. This is a very common sign of strength, frequently seen just before an up move takes place. But you must have strength in the background, meaning a shakeout or bag holding. A test is doing exactly what it says. It's testing something. It's testing for supply or for sellers. Too much supply, the market will fall. If there's no more supply or sellers at that price, the market must go up. If there's too much supply, a test can fail. And if you see a failed test in a weak market, it confirms that the market will continue to fall. Tests need 2 bars to confirm strength. Remember that. Always looking at 2 bars. A test can fail. So we always wait for the next bar to either confirm it by closing higher, but remember you're looking for that strength in the background. If you have weakness in the background and you see a test and the next bar is down, this is a strong sign of additional weakness, and we call it a failed test. Here is an example of a test in a rising market at the bottom of a trend channel. It's one of the best places you can ever buy anything. First of all, this particular stock, Goldman Sachs, which I like to trade, had a very strong uptrend and there was strength in the background. Secondly, this market fell to the bottom of a long-standing uptrend channel. So it was a very low volume bar, very narrow spread, but the next bar responded very positively. And in fact, I can tell you, Goldman went on to make $200 after this test, actually. And it's a narrowing of the range, and the volume should be less than the previous 2 bars. Should be. Not always. You can get high volume tests as well. But the best tests are when you get a narrow range, low volume, and the next bar closing and responding higher, as you see here. Now, that is what we refer to as a test in a rising market. It's one of my favourite signals. Or no supply. You might even get signal number 198, 199 appear on that. Here, again, this is a very, very common type of test. First of all, the market's marked down and the volume is enormous. Now, generally speaking, when that happens, you look at the next bar, it closes level. There's no change in behaviour here, but we've stopped the market. It's gone back up. It's come back down into that price level. The volume's now lower, much lower, as you can see, than here. So that's telling you there's interest in that area because professionals have bought here, hence the market went up. They've come and tested that level. There's much lower volume, but it's still not low enough. And so finally, they have another go, one last go, and they come back down into the body of this bar and look at the volume on this narrow ranging bar into the body of the bar behind it, closing in the middle, no volume at all, and the next bar responds. And then just over here, the market springs. Narrow range, that would also produce a signal called a test, and up we go. And those are what we call tests of supply. Tests always tend to come in after you've seen high volume. That's when they work best. And if the high volume is on a down bar, as in this instance, then it means that you've got some sort of shakeout present. And that will mean that you're going to see higher prices. This particular setup, I would say, is one of those I'm going to say is a buy signal in Trade Guide. First and foremost, you have a down move. You have at least 4 or 5 down bars behind you. The news is going to be bad here because professional money have panicked the market. The herd are panicking. Lots of selling going on, which means you've got an increase in volume on down bars. But watch what happens here to the spread of the bar as we come down. Widespread, narrower spread, much narrower spread, an extremely narrow spread. That's very, very important. If you see a market falling with narrowing of the thrust, as it's called, or narrowing of the spread, and then you have a very high volume bar closing up on the high, but it must be a down bar, remember, closing lower than the bar behind it, but it's closed on the high. Immediately, this is what we call a shakeout type bar. If it's immediately tested within 2 or 3 bars, as you see here, which is a narrow spread, low volume bar, and the next bar springs and pops up, you can go long. You don't even have to wait for a secondary test. Very often, that will turn the market. Very often. That's a very strong setup. Any questions about that? Again, please, I do encourage you to ask questions if you're not sure about anything. If I'm explaining it clearly, then that's great. That's what I'm here to do. But if you've got questions, I urge you to ask them, because this is your opportunity. Okay, I'll just give it a few seconds just to see if there's any questions coming in. Would this be a buy signal? Yes, it would. Yeah, John, absolutely. This is a buy setup. There's no other word for it. You see that setup, and it will produce, yes, it does produce an alert, Phil. Yep, it does produce an alert. Yep, that will produce an email alert to tell you that you've got a shakeout followed by no supply. All right, Pete's asking, hi Pete, what if that high volume bar is just slightly up, so it becomes an up bar rather than a down bar? If this bar here, look, and I know what you're saying, I think you're saying it actually, instead of closing there, it come up and went up and closed, say, there on high volume. Is that what you're saying, Pete? You're saying it actually closed into the body, so it became an up bar rather than a down bar. Yeah. When you read Tom's book, he'll tell you that if you get an up bar on high volume, it's a sign of weakness. Well, it is. It's much stronger if it does this. It's a stronger signal if it does this. If it does that, however, and closes as an up bar, it might produce a red indicator there. So I would wait then. I wouldn't, because what happens there is if the next bar goes up and it's no demand, it means the market's not ready to go up yet. So I would wait. This setup here is much higher probability than if you have an up bar here on high volume. If you get this down move and then you suddenly have an up bar on high volume, that can be weakness and can be further selling, especially if the next bar closes lower and then you get no demand. And you want to be short there, not long. So if it's an up bar, you disregard it. You wouldn't trade it. You certainly wouldn't trade it long. You'd wait and see if it changes behavior. So if it's a good question, if that is an up bar, meaning it closes higher than the bar on very high volume, look to the next 3 or 4 bars to tell you. If you see an upthrust or no demand, get short. Get short, because it means that this bar is further selling. But on a down bar, which it is, and remember, you can look at the bottom of this bar here. We come down and we close up on the high. That will produce a green signal every time because it's on a down bar. And then if it's tested and immediately you take out the top of that bar, very rarely does it not move higher. And if you want it to be safe, you wait for this bar here, look, a test, and the next bar goes up. And that stock rallied about 200%. Does that answer your question, Pete? If it's an up bar, I'm a lot more cautious. I wouldn't be thinking of that wouldn't be a buy signal if it was an up bar. Does that make sense? Good question, though. Okay, any other questions? Yeah, I'll take a break in about a couple of minutes. Yep, absolutely. If it does close up slightly and then immediately tests like this in a chart, is that strong? If you have an up bar on very high volume and the very next bar usually is a down bar on very low volume and the next bar responds and closes higher than that ultra high volume bar, then I would consider that to be strong, yes. The golden rule to remember with ultra high volume bars, when you see them, is look at the next 3 or 4 bars to tell you if they're genuinely weak. I will tell you 80% of the time they are genuinely weak bars. 20% of the time they're actually a sign of strength. Because if you look at how a market needs to rally, sometimes if you've got resistance to the left, the only way you're going to push through it is with effort. And effort takes ultra high volume. So if you see an ultra high volume bar pushing through resistance and it's immediately tested, you don't want to be considering shorts. You want to be considering long trades. That comes with experience, though. I will say that. I learned that with experience. If you've got a very high volume bar that's immediately tested very often there's going to be another leg up, very often. If you have an ultra high volume bar, the next bar closes lower and then you get a no demand bar at the same price, meaning an up bar on low volume, then that tells you that it's weak. It's not going any higher. Here's another example, look, of a test after a shakeout in the background. Here's what actually happened in that stock. There's the shakeout. There's the test. Come back down. We have a little test here. We rally. There's the ultra high volume peak. This is actually answering your question. Here it is, and it's immediately tested at bar B. Up it goes, and it doesn't ever look back. But that here, bar A, is an ultra high volume up bar closing on the high. It's immediately tested at bar B, and in fact, indeed, the bar behind it. It never, never, never responds. You do look like you get no demand there, but the next bar closes higher, so that can't be no demand. And then you've got another test at bar C. You get a level close, and bang, we spring upwards. All right, let's summarise that, and then we'll take a 15-minute break. So after you see a test, you must have strength in the background. And what I mean by that is a shakeout, which is important, some sort of climactic action, maybe bag holding would be even better, but you must see some strength. Place a stop under the low of the climactic bar and place a buy order above the test bar. Now, the reason you do that, you don't have to place the order there. You can wait for the market to close higher than the test bar. It shows it's successful. Remember, a test can fail, and you can retest an area several times before the market moves up. So placing an order above the tests lets the market come to you. If the test fails, you're not in the position. All right, any questions? And we'll take a little break. We've been going for an hour and 20 minutes. So any questions before I take a break? Some good questions coming in, by the way. Well done for those of you that asked. Very good questions indeed. Good. I'm glad you're enjoying it. Good. Well, once you go back and review these, I suggest that once you get the recordings and the PowerPoints, you go back and review this. That's how you'll pick it up. All right, okay, doesn't look like there's any more questions. So if you have got them, feel free to type them in. Hold on, David's got one. Is it a failed test if the next bar closes at the same level as the test bar? No, that would still be deemed successful. It's only if it closes lower, David. A test bar, if it closes level or above, would be deemed successful. Good question. Yeah, when I look at a test, if it closes level or above, ideally, right, for a strong successful test, the close should close higher than the top of the previous bar, than the test bar. That's a really strong close. If it closes level and the volume is less than the previous bar on a test, I'm a little bit more suspicious. I probably wouldn't make a trading decision based on that, to be honest. I would be a lot more cautious at that point. So I'm always looking at the bars to tell me. All right, great. Okay, let me pause the recording here now. Okay, principle 4 is absorption volume. In fact, we were talking about this in the last session there. And basically, when you see absorption volume, it'll be on very high volume or ultra high volume. It will usually close, in fact, mostly will close up in the top 20% of the bar. It's a widespread bar, and it's pushing up and through an old top to the left. That's the important part. Now, this is demand. It's an effort to go up. After this event happens, the market usually rests or starts to react. Now, you're looking for indications of strength to confirm what you've just seen, and what you're looking for is testing. That's it. If you see absorption volume, it's going to put a red signal on it. The computer doesn't know any different. It sees an ultra high volume bar and it puts a red indicator and says supply present. Now, you've got to be better than a computer here. You've got to look to the next few bars to see if there's a green indicator saying no supply or test. And I'll show you how we identify that. So, absorption volume. Now, what will tend to happen? This is actually a spot forex chart. You see this principle a lot in the forex charts. Very good one to watch. Now, first and foremost, you can see that we had a serious reaction point here. The market went up on an increase in volume, closed near the low of the bar. It's not ready to go up yet, and the price falls. We come back up here. Look, the market increases in volume, comes exactly up to that level. There's a hidden up thrust there. Level closed, back down again. So twice we've got resistance to price, and the market reacts negatively. Now we approach that same price level a third time. We come up initially on average volume closing in the middle. So you'd think, well, we've got a double top here. There's no way it's going through. Boom, like a cannon. Right, now notice that this doesn't close in the middle. If that had closed in the middle, we'd probably have seen lower prices. It closes up near the high of the bar. And in fact, on the next bar, we close almost level on very high volume as well. Now, for this to be negative, you would have expected at least the next bar here to close lower, but it doesn't. It actually here and here, we test the market. Now, that is not no demand. And the reason it isn't, a no demand bar would actually have started its journey there on the next bar and then been low volume. But notice about this bar next to it here that the body of the bar is within the body of the bar behind it. And that's what makes it look like a test. And it closes near the high of the bar, but there's no volume there. And that is telling you that they've come down and probed for supply on this bar, but they're bullish. And then we go higher, and this moved up quite dramatically. So this was tested almost with it. Well, I always say, and Tom's rule of thumb is, if it's tested within 5 bars of the absorption, then it's clearly a bullish signal. Okay, clearly a bullish signal. Okay, so let's just get rid of that. So this is absorption. All right. Now I've got no signals on here, as you can tell, but you would get a red signal appearing on that bar, and you've got to watch the next few bars, which is why I never go short against a trend like that, unless if that was a very narrow spread. Oops. If that was a very narrow spread on that bar. So let's say the market had gone up, but actually the spread of the bar was there and there, closing in the middle with the next bar lower, then I would consider a short trade. But against the trend, this is absorption, and it went higher. So you've got to remember, there is always a caveat in VSA where you see an ultra-high volume bar that actually can become strong. All right, and keep that in mind. Doesn't happen very often, but in bull markets like we're seeing right now in the S&P and the Dow and the Nasdaq, you see these signals quite a bit. Any questions on absorption volume? And again, the rule to trade it, you must look for a test. You must look for a test. David says, I find that the price often tests the breakout line before it moves higher. Yeah, that's exactly what I'm saying, David. It's exactly correct. Correct. If it's genuine absorptions, sometimes they'll come down and retest the low of that bar, but for real good absorption, you want them to test the high of the bar and keep going. Then there's no doubt. But you're right, you do often see the market pull back to the low of the very high volume bar and test that level as well. And if it holds and it doesn't breach it, then it's still bullish as well. That's right, David. Okay, I'm just looking for the other questions here. Or any observations at all? Okay. Okay. Principle 5. This is a variation of stopping volume which has arrived on 2 bars rather than 1 bar. On the first bar, supply was so heavy that the professional money was unable to absorb all the stock or whatever instrument that was dumped onto the market. This allows the market to fall on the next bar, usually on so-called bad news. This can be gapped down on the opening, causing the panic. However, to close in the middle or highs indicates demand has overcome supply. Donald's saying, if you're at all-time highs, does this make a difference? Yeah, absorption volume is only relevant and only is absorption if you've got any areas of resistance to the left. If you're at all-time highs, you don't have absorptions because there's nothing to absorb, Donald. Good question. There's no such thing as absorption volume when you're in a bull market and in a strong uptrend at all-time highs. Doesn't exist because there's nothing to absorb. It's just blooming bullish, a bit like the Nasdaq, the Dow, and the S&P. So good question. So it's not relevant. If you see ultra high volume on an up bar at all-time highs, like with gold, be careful. just be careful. At some point, there's going to be a market top round, as there was in gold. So this looks very much like a two-bar reversal, this particular principle, right? We call it bag holding, okay? And I've got a much better example to show you at the end of this because it's one of my favourite setups to go long and represents one of the four strongest. But what you find, that the golden rule about this principle is, number one, there should be a downtrend in place, a strong downtrend behind you. Number two, you should be into what we call fresh low ground. That means there's no price action to the left for at least 500 bars. So you're in a strong downtrend. Probably there's been some bad news. And what you want to look for is a massive volume bar with a narrow spread. It usually closes in the middle. This closed on the high. Usually it will close in the middle. The example I'm going to show you later is a perfect example. Here, it then tests it and immediately rallies. But if you see bag holding, the best thing you can do is wait for the market to change behaviour after you've seen the signal. So wait for the green diamonds and the blue bars after you've seen the bag holding signal. And again, this particular indicator is programmed into the scanners, so it finds it. But for those of you who want to write it down, it's sign of strength 36. Okay, SOS 36 is the number. And if you get an email alert with sign of strength 36, you better go and have a look at that chart very quickly. It doesn't matter what time frame it's in. You get this in the currencies, the forex market, the futures, stocks. It's a very strong principle. Very, very strong principle indeed. So when you see bag holding, it's one of the strongest signs of strength. And I'm going to spend more time on it when we get to the four key setups. And it's a very strong signal. This will reverse the trend. This is a trend reversal signal. Be under no illusions. This will reverse the trend. Right, the selling climax. This is what we saw in British Petroleum. The difference between a bag holding signal, John, and a selling climax is the spread of the bar is wider on a selling climax. It's a much wider spread. So a selling climax, it's a wide spread down, closing in the middle or high after, and this is the important bit, after there's been a substantial down move behind you that's already taken place. The volume will be ultra high. As a market falls day after day, a point will be reached when traders will start to panic and, encouraged by bad news, will start to dump stock back onto the market. If the market closes in the middle or high, then professional money must have decided that the lower prices now looked attractive and they will start to buy into the panic selling. The activity will cause the volume to be ultra high. This marks the low point of the market. If you see this widespread down and it closes in the middle, next bar closes higher, on that type of volume, that's what we call climactic action. And the news will fool you, I guarantee. The news will be so bad about the instrument that you will look at it and go, no, there's no way anyone's buying there. Now, I'll give you an example of this. This was an absolute classic. For those of you in Australia, I know some of you here are from Australia. I don't know what the time is out there, but it must be quite late. But there was a stock which was Qantas. Okay, Now, the news came out, and it was very, very, very negative news indeed, that the stock price had plummeted because of profit losses, and you know, there was a lot of bad profit warning and all sorts of stuff like that. But immediately after this climactic, we had that 2-bar reversal that I talked to you about. And on the daily chart, I don't think I can go back that far to June of last year on the daily chart, but I'll try. Let's see if I can go, if it's still got the data. It may have. Yeah. Actually, that's interesting. There's another signal right there back in December on Qantas. So there's another climactic bar. Look, and look, that's changing behaviour. So that's why I better do a trade alert on that. Let's go back and have a look in June though, see if we can go back that far. Yeah, there we go. So come all the way down. There it is. Okay. So this is what we call climactic action. That's December. Sorry. Let's go back to June. It may have been 012. I think. Let's just. I don't think I can go back that far. I think it was there. Was it? Climactic. There it was. Yeah, that's it there. There's your climactic bar. And on the weekly chart, that whole week was what we call climactic action. And then when the market eventually penetrates the top of that bar, watch what happens. So you mark the top of the climactic bar. And you wait for the market to go through it. And you'll see here, see what happens? Makes another high up here, and then it counters weakness up at 1.5. Comes all the way back down, and interestingly enough, in exactly the same area that we saw climactic action in December, here, it's back and it's changing behaviour. So there's a stock for you to watch. Qantas. And that's what can happen when you see climactic bars. So after you see a selling climax, it's a very serious sign of strength. Again, the news will be bad. You probably will be talking to brokers who will tell you, oh, everyone's selling, everyone's getting out. The truth is, the chart doesn't lie. Professional money are buying. They're buying and buying and buying. They're bullish about the market. They're not bearish. And that will cause the market to change behaviour, which it does. Any questions on selling climax? Any questions at all? Okay, any questions at all on the selling climax? Yes, you can get an email alert for this signal. It's actually built in there, yeah. But you don't go long. Immediately you see it, you wait for the market to test the top of the selling climax bar. So I'll give you an example. So the market's fallen, and it's fallen, and suddenly your volume comes right up. You have a wide spread bar closing in the middle. That's your climactic bar. Mark the top of the bar. Okay? You can mark the close. I prefer the top. Wait for the market to mush or to source around, and then as price action goes up through the top of that bar, there, that's your trigger, and you buy on the first down bar with low volume after it's exceeded that top. That is your buy signal. All right. Okay, so the next principle, number 7, is the shakeout. Now, a shakeout does exactly what it says on the tin. It shakes people out of the market. Now, you saw the example of a shakeout when we started today in the S&P on the weekly chart. The news around here, especially if it's on an index, will be bad. And that's what's going to put you off buying, because the news will be bad. It's a wide spread down, closing on the middle or the low. Okay, most often seen after a strong down move. Volume can be high or very high. This also can, I would stress, yes, it can close on the high as well, as we saw in the S&P. If this has been seen in an uptrend, it's a very strong buy signal. So if you see a shakeout in an uptrend, it's a very strong opportunity to go long. Smart money have to buy at lower prices and will do anything to get the price down to buy more of the instrument they are accumulating. This will nearly always be seen on bad news and will often mark the next leg up of a trend. A shakeout can also be seen at market bottoms and is especially powerful if you have a selling climax in the background. So, what does a shakeout in an uptrend look like? Here's your uptrend, it's Microsoft. There's your absorption volume, okay, just to show you the principle that we just talked about. The market breaks to the top of the absorption bar. It does have a bit of a fall, but it tests the low of the bar this time. So that's a question was asked, can it test the low? It did here. It was strong enough in this uptrend to make another leg up. We come down, we have some news coming out. The price is gapped down on the news. Volume is massive. We close in the middle. The next bar is an immediate test, and up we go. And that is what we call a shakeout in an uptrend. All right, and it's a very strong principle. Again, in an uptrend, here the news will be negative, which again tends to fool the public. They see bad news, they see the price falling, and they say, oh crikey, I better get out, or worse than that, I better not get in because the price fell and the news was bad. That's how the market works. You know, professional money take full advantage of that. You can see here what it looks like. Bar A is the shakeout. Bar B is the first test. Bar C is a secondary test. Bar D is the third test of that level because there's a lot of volume there. And then bar E, we take out the top of bar A and up we go. Bar E is the safest place to buy because we've taken out the top of bar A. Okay, I'm going to make that clear. So after you see a shakeout, you don't go long, you wait. You wait until you've got a clear test and a change in behaviour. Now, if you go and look at the video I put on YouTube on Friday of the live trading room that we operate, you'll see I took a trade in the euro on a shakeout thinking I'd found the bottom of the market and then had to change my opinion about 30 minutes later because an upthrust appeared. And I actually went short again and carried on with my trade and made a lot of money. So sometimes these shakeouts, if they're not tested at the top and we don't see a clear change in behaviour, sometimes, not very often, just sometimes they don't work. But keep that in mind. So when we see those that type of behaviour in the market, we must always, after a shakeout, look for a change in behaviour and a change in trend. It's very, very important. Here is another example of a shakeout in an uptrend. It almost looks like a two-bar reversal, and in fact, a two-bar reversal really is a violent shakeout on the first bar, followed by a positive response on the second bar. And this example here, we see a test immediately after the markdown. We have a positive response. There's the test, just there, and up we go. So remember, we're always looking at more than one bar when we're looking at BSA. We're looking at the whole story in the bars that follow to give us the complete picture. In fact, on this particular shakeout here in Goldman Sachs, it was news-based. Goldman sinks, okay, on retail sales, Goldman offering. But the financial sector, which had recently led the stock market's 5-week rebound from 12-year lows, took the biggest beating by far. Okay, and so basically the news is bad, and that allows professional money to buy at lower prices. So the rule is, when you see a shakeout and the news is bad in an uptrending market, it's a strong buying opportunity. Wait for the next bar to close higher after you see a shakeout. You want to see a confirmation. If you're very cautious, you wait for the test, and that's really what you should do. All right, always wait for the test because there'll be a lot of volume on that shakeout bar. Okay, my favourite indicator to go long is a test in a rising market. Now, when you see this signal, the most important thing to remember is you must have an uptrend in play. So you must have green diamonds and blue bars if you're using the Trade Guider software system. Any bar in an uptrend with strength in the background, like a shakeout behind you or bag holding signal, is a place to go long. Now, I make more money with a test in a rising market signal than pretty much any of the others. So it's one that you should learn. Now, first of all, it'll be a down bar on volume less than the previous two bars. And it shows lack of selling pressure as the market's falling. Now the background's very important. This is only an entry to the long side if you've got strength in the background, not weakness. You don't want to see an upthrust and then a few bars later a test in a rising market. It wouldn't make sense. You wouldn't trade it. But if you saw a shakeout, the market began to rally, it took out the top of the shakeout bar, and then you saw a test in a rising market, then you go long. So it's a higher probability entry to the long side when it's in an uptrend. Do not enter long trades in a downtrend on this setup, all right? So if your market's trending down, you see test in a rising market, as the market bounces maybe because it's got a retracement, you're not going to trade it. We're only going to trade this when you've got strength in the background. And so this is the actual one I think I traded actually in the trading competition in New York. So here you come down, all right, and we can see that the market tests along this level, and this is called no supply. This is not a test in a rising market. This is no supply. There's the supply on this bar. It comes back down 3 times, and the volume is low on the third test, and up we go. That's what we call no supply in the market. Or no, when I, in my head, say to myself no supply, it means no selling pressure on the market. No selling pressure. And you can see there's no selling pressure because as they mark the price down, professional money withdraw their interest in getting into the market on the low side because they've already bought. And that causes the price to rise. Okay, here is the actual trade setup. This is the actual trade that I took in the New York Traders Expo. You can see there were multiple entries that you could have taken. Here's your strength. Here's your change in behaviour. Here's the entry. There's a secondary entry, and there was a third one higher up. And that was a 2-minute chart. 2-minute chart. And behind us here, you can't see it because I've got the signal box. We had the shakeout, the widespread down bar. So this was a classic setup. Accumulation, rally. Accumulation, rally. And again, after the strength is there, you're looking for the pullback. And look at what happens to the volume on the pullback. See here? There's your pullback. Look at the volume. That was clearly, as the market was falling, they were withdrawing their interest. And then you had an up bar confirming the no supply. Up we went. And again here, you see no supply coming into the market on the 2-minute chart. That's a clear entry because of the strength that's over here in the background. And there's the signal, number 30. And that came in on a 15-minute chart. The market went out. You can see what the market did actually. But all the way up here, it went up some 15 points. I traded 6 points of that in the New York challenge. Any questions on this? Because that is also programmed into the scanner, number 30. If you see that, classic setup, SOS 30. Okay, I'll just wait to see if there's any questions coming in. Okay, David, would you go long on the high of the no supply bar or the next bar that has a lower high? I would actually go high on the next bar that has the lower high. Okay, when you see no supply in the market, really you want the next bar to close higher, which it should do. And as long as that next bar is closed higher than the close of the no supply bar, then you can go long. Okay, good. Good question. Any other questions? That's a good question. Any others before we move on? Here's a great example of no supply. Again, look, you can see it here. Testing a rising market. Look what the market did. Okay. And this is a classic example. When you get a high volume up bar pushing through previous weakness, and it's immediately pulled back on low volume, and the next bar responds. That's the bar that I go long on, David, right there. Okay. I actually took the trade on this because basically once I saw that and the next bar pushed higher, and I stayed in the trade because all along this line it was tested. Look, the top of that bar, which was the response, they tested it once and then boom, another leg up. And this is what you're waiting for. It moves up and then moves up that another leg. That's where you make your money, as it pushes up. Okay, and you've got a copy. Have you all got a copy of the PowerPoints, by the way? We put them up in your. Can you just type in yes or no? You should all have a copy of this PowerPoint slides. I'll just make sure you've all got that. It's in your customer-only area of the website. All right. Yes. Okay. Just so you know, Donald, it is actually in your customer. You log into your customer-only area of the website, and the recording of last week is there with this PowerPoint, and this recording will be in the same place. If for any reason it's not there, just email Richard B, R-I-C-H-A-R-D, Richard B at tradeguider.com. Right, okay, a couple of you said there's nothing there. All right, at the end here, I'll make a phone call. Stay on the line, and we'll go and check it. Okay. So, go long, or when you're going to go long, after you see no supply or a test in a rising market. When you see it, there must be climactic action or shakeout or something in the background that's strength. Again, once you've got that, and as long as the diamonds are green and the bars are blue in the software telling you the market's going up, then there's no reason not to go long. Okay, now we're going to talk a little bit about trigger numbers before we get to some of the setups that I like to use. And I'm going to use live charts I'm going to use a couple of screenshots and some live charts to show you some of the setups. I actually traded last week, so you can actually go and look at them as well on tradingthemarkets.com. So if you want to see the actual live trades that we took, we're going to archive those and put them on our website, tradingthemarkets.com. But if we look here, you'll see that one of the most important things that I do each day before I intraday trade is I go to the 15-minute or the hourly chart and I mark the yesterday's bars that have got ultra high volume on them. And I project from that the top of the bar and the closing price. That's all I'm interested, really. Top of the bar, closing price. This one happened to close on the high. And I then project those lines out into the trading day that I'm trading. I then watch what the market does as it reapproaches those lines. Now here, there was a lot of supply, but it got immediately tested and went up. So the next day they brought the market down. As you can see at the market open, they marked it down to the top of that bar. We then closed in the middle. And then they brought it back down again and it closed on the high. And I knew that if I wanted to take a long trade, if I put my stop below that green line, which is a wide stop away from the market, very unlikely I'd get stopped out. But as it happens, and I'll remember this very well, the market began a rally up to the very high of the overnight session. And I was then able to move my stop using a trailing stop or a chandelier stop up. So I was then in a profitable position, couldn't lose any money, and then got into a trade that was locking me into profit all the way. So it's very important to identify, if you're intraday trading, yesterday's or whenever. So for instance, on Monday, I'll be looking at yesterday's ultra high volume bars and projecting those out. Okay. And here again, you can see what happens when you do that in these different markets. The market seems to come and respect these lines for a particular reason. And maybe we'll go to a live chart in a minute and we'll actually do that. In fact, we will. Why do you draw the middle line from the close of the bar instead of the top like the other two bars? Okay. In this instance here, I'd still pay attention to the top and the bottom, Pete, okay? But I'm looking at the closing price of the bar as being quite important. And in fact, when I do my trigger numbers, I'll often mark the close and the top. Okay, in this particular example, I just marked the close because I wanted to show you how the market reacted here. If I drew too many lines, I couldn't show you what the bar looked like. But here, you can see I marked the close. We tested it once. We were marked down through it. And then as it came up here, we had a very healthy bar. And then look, right on exactly to the tick, the market's marked down, very low volume, responds positively, next bar's up, and we make a new leg up. Well, we'll do it in a minute. We'll actually go and draw some lines on the S&P or the NASDAQ, and I'll show you how we do that. All right. So, finishing off on the PowerPoints now. I think we're still okay for time. Before you go long, these are some of the bullet points that you must ask yourself. Look at the trend. Are you in an early stages of an uptrend, or are you clearly trending down in different time frames? Remember, you don't want to be long if the market's pushing down on you. Is the market rising with no professional support? I mean, is it going up on no demand? That's not a good place to go long. Is the high of each bar higher than the previous two bars? Well, that means you're in an uptrend. And if you're in an uptrend, that's fine. You want to be looking for long trades. Are you into fresh low ground when the accumulation starts? Remember, if a market comes down into a price area where there's no price action for at least 500 bars, we call that fresh low ground. And that, if there's a bag holding signal there, it's going to be a great place to buy because you're buying the bottom. Always look at, have you got trading ranges to the left? I mean, when a market is range bound, it will bounce off the top and the bottom of the trading range. So that can be good places to take a trade. Always ask yourself, if the news is bad and there's a climactic action bar or a shakeout, is the herd selling and should you be buying from the herd? Be contrarian. Look at your trend channels. Okay, we'll do a couple of trend channels again in a minute to show you how you draw them. Are you oversold or are you overbought? If you've got weakness in the background, like a buying climax or the end of a rising market, you don't even consider going long. You think of shorts. Remember, don't buy the market as it's going up. Buy as it's falling down, as long as you've got strength and you're in an uptrend. Buy dips in an uptrend on low volume. So what you're looking for, the market trends up, it dips, it trends up, it dips, it trends up, it makes new highs, it dips. These are the places you want to be looking to buy the market. And as long as the volume is very low on these bars and there's testing or no supply, it's going to make another high. And what you should have back here is a shakeout or a bag holding signal, just here. Always look at the background. The background is going to be your key. So in summary of everything we've talked about in the last week and this week, remember that each of us are unique. We have different account sizes. We have different loss tolerance levels, different experience levels, different ways of viewing things. I mean, two people can look at the same mountain from exactly the same place and they'll see completely different things. One will look at the snow on the top and the lovely trees. The other person might look at the sunshine bouncing and glinting off the glaciers, but looking at the same thing. And all of us will have different levels of self-discipline. The strategies in BSA are a guide. You must adapt them to your style of trading and to your trading personality. Only you can do that for yourself. Remember, the key principles apply to all markets where there is volume available and in all time frames. I mean, we've been looking at we've been looking at multiple markets here, mainly stocks, but you could have used and can use VSA in futures, commodities, spot forex, doesn't matter. Keep it simple, stupid. KISS. Nothing here that I've shown you is rocket science. It's very logical. It's based on principles that have been around for over 100 years. Take a holistic approach to your chart analysis. And what do I mean by holistic? I mean emphasizing the importance of the whole and the interdependence of its parts, meaning that the market is an ongoing beast that just keeps growing and growing and growing. And there are different time frames in that market when it's open. So choose the time frames that suit you. Some things to keep in mind. Strength will appear on down bars, which I've shown you. Weakness will appear on up bars. The background of the chart and knowing whether you've got strength or weakness in the background is vital. Has the strength or weakness appeared at the top or bottom of the channel if you're using a trend channel? Is this a major trend reversal or a retracement? Is the news particularly good at the time you see these things or bad? If it's good and you're being told to buy gold and it's a safe haven and you see a buying climax, you better start thinking of shorting. If the news is bad, if they've told you BP can't cap the well and you see a selling climax, ask yourself the question, are you really being told the correct information? Is demand overcoming supply? Or is supply overcoming demand. If demand overcomes supply, the market must go up. If supply overcomes demand, the market must go down. Everything you see in the past will be there at the right edge of your chart. So remember, we may be looking at historical charts, but everything I'm teaching you here applies at the right edge of the chart. VSA is discretionary methodology. It still requires discipline and money management. VSA can be more effective if you use it with support and resistance or wave analysis, wave counts. I'm going to be doing a seminar, hopefully next month, with an expert on wave and Wyckoff. Basically, he uses Elliott wave and VSA, and it's very, very effective, I can tell you. His name is Rafał Glaniszki. He's Polish, and he's a very good trader. You must use more than one time frame to see the bigger picture. I use 4. Very important. If you listen to news, have a very contrarian view of the contents when taking a position. I think I've demonstrated that. I don't need to sort of re-go over that. And remember, the chart never lies. Rely on your charting skills. Okay, that's the PowerPoint over. Before we go down and get to some live charts and actually show you some principles of how we set this all up using the sequences, is there any questions at all? Okay, any questions at all about today and session 2? Before we now get to the final 4 setups that I like to use, which completes the 20. So you've got 16 of the key principles. Now we're going to learn 4 of the highest probability setups. Okay, I'm just going to wait to see if there's any questions before we move on. Okay, doesn't look like there's any questions at the moment, so I'll keep watching while I'm setting the charts up here. All right. Okay, doesn't look like there's any questions. That's good. Okay. So what I want to show you now is, well, I'm going to talk you through a setup that I traded on Friday, which is one of my favorites. And I'm going to show you a shakeout that didn't actually work. And I'm going to show you, in fact, we'll start with that, because this is important to know when you get this. I'm now going to talk about something called a countermanding signal. Okay, now you can actually go and view this particular trade on YouTube. I've actually put the whole trade up. And you'll see the entry, you'll see the exit, you'll see the reason why. Now, one of the things that happened, I was short and have been short the euro because of what I saw here. And that's where I actually took my short trade. All right. Now, that is one of my favorite setups. Okay. So setup 1 is the up thrust in a downtrend. All right. But it's got to have weakness in the background. All right. Now, there's the other couple of things I like about that particular up thrust. Number 1, it's on very, very high volume, as you can see. All right. Number 2, the next bar collapsed. Number 3, we then went back up to the area where the up thrust appeared on no demand. And in case you missed any of those principles, if you were trading the euro, we were watching this in our live trading room. This was confirming everything that was behind me. And then over here, another up thrust. And then here, add to the position, a trap move. Now, all of this happened because of something in the background. Can anyone guess what it is? What do you think was in the background to cause all these trades to happen to the short side? Have a guess. Anyone? I remember I've given you 2 serious signs of weakness that have to be in the background on a bigger time frame. Well done, John. Good. Well done, Phil. Think about it. What's a serious sign of weakness? A serious sign of weakness. Think about it. Okay, I'm going to put this chart up now. Right. What's a serious sign of weakness? There's two of them. I know we did this last week, signs of weakness, but you need to go back and study this. A buying climax or the end of a rising market. SOW1 or SOW5. Now, what makes that so powerful? Number one, it's market top. Number two, the next bar closes on the low. So it confirms the indicator. If you read it, the next bar should be down. When we refer to a down bar, we refer to a price bar that closes lower than the bar behind it. And up here, you can see more supply enters the market. I begin my downtrend channel, more supply comes in. So you sell at the top of a downtrend channel. Now look at why this trade setup is such a high probability setup. Just type in yes or no. Do you agree with me that certainly on the 4-hour chart from this point, we're trending down? Yes or no? For the last 24 or 30 hours. Do you agree with that statement? Yes or no? All of you. From this point here, are we trending down? Yes or no? Does anyone think not? Does anyone think that we're going up? Okay. Here, we've got a trend cluster, all right, which is this grey box. Now, I talked a bit about trend clusters last week. I use them because on a big time frame, if you have a trend cluster and the market punches up to it with massive volume and collapses on the low of the bar, followed by no demand, and I've got no signals on here, I can just read the bars, I know the market's weak. So what's the next thing I'm going to do? I'm going to go down a time frame to see if I can find confirmation that on the 16th of January, on Thursday at midday, there's a short trade setup coming. Let's go and have a look. Okay, so here, okay, just after midday, at 2 o'clock, this happens, an upthrust. Now, at that moment in time, the market on the hourly chart had not yet changed behaviour. So I didn't, although I shorted there, we added to the position in the live trading room on that bar. Now, look at the 15-minute chart. Notice from here, you get confirmation. At the same time, on the 16th of January, we saw an upthrust on the hourly. You've now got number 122 confirmed on the very next 15 or next hour by a trap up move. So notice how the hourly, the 4-hourly and the 1-hour chart and now the 15-minute chart are all aligning with each other. So now, 5-minute chart. Does it change behaviour? Of course it does. All the way through the whole day, on a 5-minute chart, you've got entries because all the other time frames were short. Upthrust. 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 3 of them. And you'll see me trade those. Now, interestingly enough, while I was short in the trading room, I actually thought I was going to get long on here because I thought that is a test of a climactic bar and it's held. So I did something a little bit aggressive. I went long. And when the market went up through 84, I was in profit. As soon I was just about to close the trading room, as you'll see in the video, and that happened. You know what? I had to change my opinion. I had to change my opinion because the next bar confirmed it. That when you see that, it means that shakeout is only temporary. It doesn't mean anything at that point. And the market continued to fall. Now, in our Trading the Markets alert service, I gave the signal on Thursday the market would get down to 1.3500. The market made a low of 3.515. I was 15 ticks away. All right. Now, I have a point and figure projection count, which tells me where the market was going. So it was no accident I knew where it was going. And by the way, I'll let you all have the video at the end so you can go and have a look at that. So this setup, the upthrust in a downtrend, is a very high probability entry to the short side. If it's followed by no demand in a downtrend, it's even higher. And by the way, the most important part for me about that setup, when I took it, as you'll see on the video, all of these in the scanner were pointing red. Red diamonds, red diamonds, red diamonds, red diamonds. What does it tell me? The market's pushing lower. Yeah, Tajus, I know you mentioned in the live trading room that you thought that it was weakness there, and you were absolutely right. Well done. I actually did change my trade, and I carried on short. Because as soon as I saw it go above and on an upthrust, I'm like, So I did go short again. I actually made a good trade. So it was a good setup. Any questions about that setup, the upthrust in a downtrend? Any questions at all? Any questions at all? All right, let me show you the next one then. And now I've actually taken a screenshot of this. All right. Now, I might have shown you this last week, but I want to show it to you again because it's such a good trade. And actually, this alert, I can't remember. I think we may have shown you this last week, but I'm going to show you again anyway because it's worth drilling home. So this is a bag holding signal. Now, we saw this on gold on Thursday. And gold continued to fall, and then it found its mark and went through the bag holding signal. So this particular indicator happens after a rapid fall in price. We see a highest volume bar, narrow spread. Now you mark the top. You don't do anything until the change of behavior happens. We mark the top. Now we change behavior. After the signals appeared, there's definitely buyers there. It comes down a bit further, but then it starts to change behavior. Now over here, the diamonds are still white and red, so we're not going to go long yet. But here, the diamonds change to green. And we come into this area here, which is now above the top of the bag holding signal at 1.3550. So now we look for signal 199. Look at the volume on that signal at the top of the bag holding bar. There's no volume there at all because professional money have already been buying. This is a 5-minute chart of the euro. Okay, this was a trade I took in December in our trading room. 5-minute chart of the euro. So you've now got clear, no supply after you've seen this bag holding signal. It's a very serious sign of strength and a very serious trade setup to the long side. And if you see it, you must think of long trades almost immediately. Any questions on this setup? Any questions at all? Okay. Yeah, Tajus, we do have that. Exactly. There is some distribution in gold. I agree. Okay, I'll just wait for the questions to come in. And I'll pull up the next screen, which is in fact gold. Okay. Excellent. Good. All right. Okay. So now we're going to look at buying climax followed by no demand. Okay. And this is a very, very clear principle. Now you'll see this on a 1-minute chart. This happens to be the weekly chart of gold that we looked at last week, but I had an email about it. So here on the 12th of August, the same time as the E-mini S&P was being bought, professional money began to sell. Okay. And when you see a higher volume bar like this, mark the bottom, the top, and the close. That's what I did. In fact, let's put a red bar on here. Put a red bar on the top. and then put a red line, I should say, rather than bar, on the close, just here. Okay, just here. All right. What you see here is the market sees the weakness on these bars. So we come up to it first, we come up past the close of the bar, no demand. The market falls once. Now, that's an important level, that no demand bar, because it's no demand after you've got the climactic bar. So mark the closing price of that no demand bar and see if you get no demand at that level in the future, because it could be a good place to trade it. You can see here, if we look at the high of the no, or the close of the no demand bar, it closes at 1788. We look at this no demand bar here, it makes a high of 1789 and then fails. Both no demand bars are confirmed because the next bar is down. Here, next bar down. Here, remember this is a weekly chart. So look at the move that happened, the subsequent move. Very significant. But professional money are very devious. They don't just, when they're bearish, they want to unload more. So the price has come up here again to exactly the same level. No demand. 3 times. Not once, 3 times. And in 2012, I was in Poland doing seminars and I was forecasting gold would go to 1200. And no one believed me because we were still trading at this trading range. And gold had been in such a big bull run for 12 years that everyone said that cannot be the top, but it was the top. And even here, where we expect to find some support, if you mark the bottom of that bar now and the closing price of that bar, it's going to tell you a story. There's still supply there. Look. And I don't show this publicly. This is the first time I've shown you these lines publicly because I keep these a little bit of a secret because they work so well here and the bottom here. Once you actually frame these out on these high volume bars and in a downtrend, look here. That was one of the first trade alerts that I did to short gold in our Trading the Market service. It's in the right place. Weakness in the background, change in behaviour, weekly downtrend. The market attempts to find support. If that's genuine support, you wouldn't upthrust it. Where's gold going? It's going to 1,000. But there is a little bit of support down here. So I know that on this low, right, the low here at 1179, that is now for me a key level. And I've actually got sell orders just below that, resting orders in the market ready. Because when it happens, it'll go quickly. I don't want to miss it. So right below us here, where we've got the support line, I can see that they've held it once. They've tested it. So this is what we call the ice line. Now, have you all heard of the saying that Wyckoff used? Well, it actually wasn't Wyckoff, it was Bob Evans. But have you all heard the saying, breaking the ice? And jumping the creek, have you heard of those sayings? Yes or no? Falling through ice and jumping a creek. Have you heard this? So I'm going to show you a setup now that some of you might have heard it. If you studied Wyckoff and the Wyckoff method, you would have heard of this. I'm going to explain it to you now. Okay. So, Wyckoff told us years ago that markets had key levels of support and resistance, which we know. In order to break through certain key levels, you need to see a lot of volume coming in, almost to punch the price through those levels. Now, we can see here that this level here was broken very clearly, and it was broken again. But here, at 1180 on gold, we've clearly got some support. Now, this is called currently the ice line. We've got a clear support line here, and it's back down there again. Didn't break it, tested it, another test, and this time it's gone up and made another high. This is still weak. There's nothing seriously, on this chart, on this weekly chart, there's nothing that I would make me want to buy this. But there is support. Now, what Wyckoff said is imagine a Boy Scout was skipping along here, jumping up and down, having fun. The ice held firm here because it's 10 foot of ice. And he comes up, he takes a running jump, comes back down onto the ice. Again, there's 10 foot of ice there. It holds. Price is held. What we now need is another running jump. Now, if he comes back down and hits that ice line here and breaches it, he will sink quickly. So will price. So to have a sell order ready down there is a very good strategy, because once it goes, it will go very quickly, like it did here, even like it did there. See how quickly in 2 weeks the price collapsed. And you want to be in those trades. So this is what we call the ice. And if you see a widespread down bar through that ice, the ice then becomes resistance. At the moment, it's support. The minute it's broken, because it's in a downtrend, it will become resistance and great places to trade no demand bars on weekly chart. I'm looking at weekly here. Yeah. Would that work on a 3-minute chart? Absolutely it does. Works on any time frame, doesn't matter. Here's a 5-minute chart of the euro. Okay, you can see where we broke through the... Here's your ice line, look. It held, bang. Look at the volume associated with the breakdown. We go back up, reject it, no demand, all right, test, back down. 5-minute chart, same principles. It works. This stuff absolutely works. Any questions on the ice line? These are very good setups when you break through the ice and go up on no demand, or you up thrust the ice, as we've done here, look. Effort versus result again. There's the up thrust. Any questions? We've got about another 10 minutes. I've just got a couple more charts I want to show you. I know I'm trying to keep it to around an hour and 15. I'm trying to keep it on time here. Any questions at all? Is the ice line always support? Well, yes, until it's broken. Yeah, it's going to act as support until it's broken. Yeah, so in here, even up here, you see, when you jump the creek, it's absorption volume, what I talked about earlier. That means, and what Wyckoff, in fact, Bob Evans was telling us about jumping the creek, it's like a Boy Scout trying to get across a river or a creek. If he stood at the edge and just took a running jump without any energy behind him, he would fall in the creek. So he takes 15 steps back and runs and jumps, and that causes the wide spread on the price bar, if you use the analogy, and that's what causes the absorption to happen, and that's energy in the market, basically, kinetic energy in the market. Good, excellent. Okay, so doesn't seem to be any questions there. Okay, and now I want to go to the coffee contract. Where is it here? Okay, here it is. All right. Okay. Now this has got some very interesting principles in it as well, okay, which we need to look at. Now, first and foremost, you can see we've been in a very strong downtrend, okay? In a strong downtrend, you look for up thrusts, you look for here, reversal bars, where basically you go up with one bar. This is what I want to show you, this principle, is a reversal in a downtrend, number 97. Again, that's programmed into the scanner. So let me go all the way back there, and we're going to look at this as to why this principle here, number 97, is extremely high probability, okay, and why it's a very good trade, because you can put a stop just above the first bar. All right, so we talked today about bottom reversals, but this setup here was one, again, I gave an alert on. This was when we had our trading room in the VSA club, and I went into the club and I warned the traders in January in the VSA club that this was looking very weak. Now, this is really the third high probability setup that I use. You've seen bag holding and up thrusts in downtrends. This one is probably 85% to 90% accurate. So the first thing that has to happen is you have to have a downtrend with weakness in the background. That's the first thing you must have. So up thrusts, and the bars have to be red and the diamonds have to be red in at least 2 or 3 time frames, but this is a weekly chart and it had been in a downtrend for a long time. Now, the next thing that has to happen on this trade setup is the market needs to go up on an increase in volume, and it has to be very high, higher than some of the other volume bars behind it. This happened to be very high. You can see here. So this is almost the highest volume, as you can see, for about 3 or 4 months, probably longer than that, 5 months. So I've got an up bar immediately on very high volume. Now notice it didn't put a signal on that bar. There was a reason for that. What I liked about this, when I first saw this bar, is the range of the bar was narrower than the range of this bar here. And it was narrow, but it closed up on the high. So I didn't have a setup at that moment, nothing at all. But the next week was an incredible feeling. Because if you see this, you know you're going to make money. It's almost like you know. Because what happened is the top of this bar, the close, was never penetrated by the body of this bar. It just began to journey down. And the volume was pretty average on the downside, but it told me that if that in the downtrend was buying volume or that was demand, then this was confirming actually that was supply, sellers. Now, as soon as price action takes out the low of that bar, you can think of an immediate short trade. You don't have to wait for the bar to close. But in this case, because I was doing a trading room, I actually waited. And you can see here, it produces a signal. Now you can see it tells us number 97. Again, it's built into the scanner, SOW97, a reversal. This works much better in a downtrend, but it also works very well at previous resistance as well. So the first bar is an up bar, which you can see, right? Which means it's closed higher than the bar behind it. It's closing on its high, followed by a down bar retracing most of the previous bar's gain. Sometimes this can appear as a top reversal. Add more weight if the volume is higher on the up bar and into fresh new high ground. Okay, well the volume is higher on the up bar, but we're not into fresh new high ground, meaning we're in a downtrend. It's even better. Background. Have you seen any previous sign of weakness in the background? Yes, I have, Tom. There's an upthrust and there's supply, and we're in a downtrend. Yes, Tom, I have seen that. Okay, there has been an effort to rise from the increased volume, but for the next bar to close down shows supply has appeared. Strong markets do not appear in this way. Future. This setup shows weakness. It's very, very specific. One of the most specific in the software, and there's many of them like this, but this is very specific. This setup shows weakness. And you've got an upthrust behind you, you've got supply present, and you're in a downtrend. So start ticking the boxes. These are my checklists. Tick, 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 tick. Yeah, this works. Okay. However, be cautious if volume on the down bar was very high to ultra high with the next bar up. Well, it wasn't. The down bar was on average volume. I can see that from here. This will confirm there was buying on the down bar, although still a lot of supply. If the next bar is down, closing near its lows, this confirms the weakness. Well, it does. Okay, so we know it's closed near its lows. Also, high volume up bars on narrow spreads show further selling. Here's a high volume up bar on a narrow spread. It's actually a level bar, but it's an increase in volume, narrow spread. Everything makes sense. Subsequent no demand bars confirm the weakness or upthrusts. All right. With weakness in the background, this indicator carries more weight. Okay, and then you just read on. But remember, you see, it says here, remember, you need to look at the whole picture rather like slotting together the pieces of a jigsaw. The whole picture makes sense. Weakness, downtrend, upthrust, change in behavior, upthrust confirmed by the next bar down, by the way, as you can see. Weakness in the background, upthrusting the weakness, downtrend in place, 2-bar reversal. That is a very, 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 very strong setup. And you can see what it did to the chart until we found some support on this bar here. And it tells us there's strength coming in there because two things happen. You have a narrow spread on the bar. You have the highest volume for a few weeks and the next bar closes higher. Okay, it closes higher on low volume or an increase in volume and then it upthrusts, but it doesn't cause the market to fall further and they mark it up. But I think we'll have another opportunity there. Any questions on that one at all? Any questions on that setup? And I've got one more to give you before we go. Any questions at all? Please, either I'm doing an extremely good job, or you just haven't got questions, and that's great. If you I'm pleased if you've got a question on anything, any subject. It doesn't have to be on the charts. It might be about something to do with your trading or whatever. Just ask it. Anyway, let's go and have a look then. The final chart, which was on Apple, I think. Yeah, let's just look at my notes here. Oh yeah, there it was. That's it. Perfect. Okay. So my final chart here is what I'm going to call this is called the change in behaviour. And what I want to show you here is how this bar here, followed by that bar there, change the behaviour of the stock. And then here, in fact, that test was I gave that as an alert, by the way, and it's back down into that area, but I still think we're going to go higher on Apple. But I want to talk about, I've shown you weakness, and I want to show you what stops the market. And this signal that I'm about to show you is, again, it's programmed into the scanners. Thanks, Lars. I appreciate that. He said I'm doing a good job. Okay, that's fine. I just like to get some feedback, because I hate that if I feel that I haven't done a good job and no one's asking any questions, either I've been too advanced and I've confused you, or I've got it dead on and you're all understanding this stuff. So it's one or the other. But hopefully it's the first one, that you all understand it. So here we have a downtrend in Apple on the weekly chart. This is a weekly chart of the US stock Apple. This is falling through the ice. Its prior support was taken out with this bar, and Apple was marked down. Mind you, it had been in a very, very, very strong uptrend for a while. But this signal here, number 94, and 57 also is the same signal, 2-bar reversal, is a very, very strong principle. But if the second bar is on very high volume, as this one is, you very often see this happening. The market going back down into that area where you have that very high volume on the reversal. And this time the volume is much lower, and the range of the bar is narrower than the two reversal bars. Okay, so that's really important about this setup. So you've got a wide range, you've got the reversal, so you know on that very high volume that came in, has to be buying for the next bar to go up. And as you can see here, the market's not ready yet because there's a lot of supply still around. There's a lot of selling pressure there. So they bring the market back down. And again here, we have the highest, almost higher than average volume. But look at the spread of the bar. All right, it's narrower, closing in the middle into these bars here, almost like a diamond shape. Now, I still don't buy there. I wait for my third green diamond to appear, and that came in and we had absorption volume. Okay, that took out the previous area of resistance on an ink. It doesn't produce a signal there. It comes back down into that area. You have still a lot of high volume around here, but then it's getting tested along these lines. And lo and behold, up we've gone. And I still think Apple's got a way to go higher, because if we look here on the bigger time frame, this is the weekly chart. What we've actually done here is we've retraced in the uptrend. That's a natural retracement after we made 700, around 400 there. That's a fairly natural retracement. And Apple has been in a very strong trend, and there's no serious weakness around, as you can see. So here's your really nice big move. First little wave, second wave retracement, and as long as it holds, we could have another big third wave. It takes out 700. Well, Apple's going to do what Google did. Now, Google was very interesting. Just quickly, I'll finish on that one. Because you can see here what a market stock leader does. So you can see here, that's absorption volume right there. That's what it looks like. See here? Here's your resistance line. That's absorption, and it's tested within 5 bars. And Google looks, there's no way that this is going to come down. Okay, so it's a very, Google is actually leading the NASDAQ. And it's one you should follow. You see any bar like that up here now, you go long. Go long Google. Because that closed on the high and was tested. And that's the principle that you're looking for. Okay, any questions? And if not, I shall wrap up and we'll say a few final words. I'll just wait for any questions from any of you. And then I'll do a summary and then we'll get this archive. And what I'm going to do, but I'm going to switch off the recording in a minute and I'm going to ring my business partner and just confirm exactly where you come in and find the recordings. Great, thanks Roger, appreciate that. If it's very clear then I'm happy. I do recommend a couple of things that you do now though. When you've got the recordings, go back over them at least in the next 2 weeks. Spend a bit of time listening because you'll pick up stuff that initially you don't pick up, I promise you. I know that. That's why I try and keep the sessions to 1 hour and 15 minutes. Any more than that, and you only probably pick up a small percentage of the information you're being given. Please, if you've got questions, let me know. We're going to relaunch the VSA Club soon. That's a great place to come and join if you want to progress and learn more. It's the vsaclub.com is the website. It's a club of traders. It's got just over 1,000 members now, and that's a great place to learn as well. Yeah, Vasily, sometimes you need to go back and just go over it slowly. I know there's a lot of information that we've given you here. I appreciate it can take a lot to sort of get in your head, but once you've got it, as Tom always said to me, he said, Gav, once you've got this, it's with you for the rest of your life, and it's true. And I've seen some really great success stories of how people have turned their lives around using VSA. Something I will make you aware of, by the way, because you're premium customers. We've launched a new part of our website. It's only in test mode at the moment, but I might as well show it to you. And before I do that, let me say thanks to all of you. I'm going to ring my business partner in a minute, but what I will do is to stop the recording, and this will be used as part of our training sessions as well for people who buy the software in the future. So let me stop the recording right now and then stay with me. I've got a little bit more information to give you.